Hello and good morning. I'm Helen Miller, Director of the Institute for Fiscal Studies. Welcome to this event on what happened to the children of the property boom. I think it's widely known that from around the mid-90s to around the mid-2000s, the UK experienced a dramatic surge in house prices. Those house price increases were very uneven across the country, meaning that some people got dramatic wealth increases and others didn't. What's less well known is what impacts that housing market lottery had. And that's something that colleagues here at the IFS have been working on. And today, Peter Lavelle, who's our Deputy Research Director, is going to present from new research on how rising house prices affected inequalities among those who grew up during the property boom. Peter will speak for around 20 minutes, setting out the differences in parental housing wealth, how that shaped children's home ownership, access to high wage regions, and labour market outcomes more broadly. He'll also discuss what that means for social mobility. After Peter has spoken, there will be a response from Jan Stuhler, who is a professor of economics in Madrid, and he'll talk about the link between housing wealth and wealth more broadly, and unpack some other mechanisms between parental wealth and child wealth. After all of that, there will be time for a Q&A with all of you. So you should have the Slido link. Please do put your questions into Slido and vote for the ones that you would most like to hear the answers to, and we will get through as many of those as we can. But for now, let me hand you over to Peter.
Great. Thanks very much, Helen, and thanks to all of you for joining us this morning. And thanks in advance to Jan for his discussion of our slides. So this is some work we've been doing on how house prices affect social mobility. It's joint with me, Peter Lavelle, and my colleague David Stark, who used to work here at the IFS. This work uses data from the Office for National Statistics, in particular the Office for National Statistic Longitudinal Study, and we're very grateful to the ONS and to the staff of the Centre for Longitudinal Information and User Support, who've been very generous during their time in helping us get this project up running and organized. So by way of introduction, so as Helen said, there was house price boom between the mid-1990s and particularly the mid-2000s, very rapid increases in house prices rising much faster than earnings. Just to illustrate that, we've got a chart here showing the house price to earnings ratio in the UK as a whole, and in two different regions of the UK, London and the Northeast. London, where house prices went up the most, Northeast, where house prices went up less than in other places. And what you can see is over this period, this from the mid-90s to the mid-2000s, there was a doubling in this house price ratio. So a big increase in the importance of housing wealth relative to income, but also that there were these big differences across the country. So you can see that there's big divergence in the house price to local earnings ratio in London compared to the Northeast, which is the dotted line at the bottom. At the same time, we've seen recently home ownership rates falling for younger people. And this is a fall in ownership that wasn't even across people by background. We already know from past research that this is something that was a larger decline for the children of parents who were initially renting than for parents who were owning. So this is some results based on a study done using the same data that we will use. By Bell et al. From 2018. And you can see the home ownership rate for 30 to 36-year-olds. So around 1990, that was around 75%, and that declined to around half in 2018. And you can see that there's the blue dots on this show the home ownership rates for the children from households where their parents owned their homes. And you can see there's about a 10 percentage point decline in the home ownership rate for that group. That group were more likely to own than the children of renters, but you can also see a faster decline in the home ownership rate for those people whose parents rented their homes rather than owned their homes, about 20 percentage points. So our questions are these two facts connected? So did the boom in house prices affect social mobility, the ability of children from different backgrounds to get on the housing ladder? Our second question is, does parents' housing wealth shape other aspects of young people's lives? Does it shape their choices over where to locate? Does it shape the labor market opportunities they have access to? And a more fundamental question is, when we see these associations between how well children are doing, either in the labor market or in terms of the wealth they have, and their parents' situation when they were children, is this a causal association, or is this reflecting other factors? So is there a causal effect of parents having more wealth on these outcomes, or is this just the role of other factors that might jointly determine parents' outcomes and child outcomes? And this is something we're going to keep in mind throughout our study. So as I mentioned, we'll be using some great data for this analysis. So we're using data on individuals in England and Wales that's been collected in different censuses. So censuses are conducted every 10 years. And these censuses have been linked through what's called the ONS longitudinal study, which means that for a subset of individuals, you can see their census records, provided they're there, from 1971 until actually 2021, the most recent census. So the census are conducted differently in Scotland and Northern Ireland, and the ONS longitudinal study is working with the English and Welsh census. So all the results I'm going to be talking about pertain to England and Wales. It's not to say these other countries aren't important, it's just those are the countries covered by the longitudinal study. And we're going to be using data up to and including the 2011 census. We haven't included the 2021 census because that was only made available recently. So what this allows us to do is to see people's census records for their children and info on their parents and their homes when they're growing up, and then following them after they've left home. And we can use this to compare the children or people who were children during the 90s to 2000s property boom. So this, for us, this is going to be a group of individuals who were born between 1974 and 1983. We can compare them with each other, depending on how well their parents did over the property boom, and with previous cohorts of individuals who are born in earlier years, compare them to those previous cohorts at the same stage of life. So this is a group of people they're going to be 8 to 17 in the 1991 census, so we can see them at home with their parents, and they're going to be 28 to 37 in the 2011 census. So the census asked a bunch of questions about people's location, your age, marital status, their occupations. It doesn't ask them directly about the value of their home or the value of their earnings. So these are things we've imputed into the data based on other things we can observe about the property and about the kind of jobs they have. So in all of this, we face a challenge. So what we could do is we could just compare outcomes for the children of parents with more or less housing wealth and see how well those kids are doing, whether kids with more housing wealth do better. But this could reflect many other factors apart from wealth. So it could reflect those parental resources, but it could also to do with the local economy they grew up in, the preferences of the child, the behaviors of the child, things that are transmitted from parents to children, skills or habits and so on, or tastes. So when we see that the children of wealthy parents are wealthier themselves, we want to say that this definitely reflects the impact of parental resources rather than these other correlated factors. So ideally, what we would do is we would look at some kids, we'll take a random selection of kids and hand their parents a bunch of wealth and not give the same wealth to some other parents, and then see how that affected the children later on in life. But this would obviously be an extremely expensive and very difficult study. So we're going to take a different approach. And in particular, the approach we're going to take is, so we're going to start by taking some outcomes. So suppose we're interested in children's home ownership rates when they're in adulthood. So we're going to look at parents who are initially owning and parents who are initially renting before the property boom. And we're going to compare the gap in those home ownership rates between the children of the owners and renters. And then what we're going to do is we're going to look at places where the boom we saw led to faster house price growth. So we saw before London in particular, sort of rapid house price growth. The Northeast didn't see such high house price growth. So we can compare people growing up in those different areas. And if that gap between the children of owners and renters gets wider in the boom period than it did for previous periods, we can treat that as indicative of the impact of housing wealth. We can say that it's going to be, we're more confident interpreting that to housing wealth rather than just differences across areas, because we're looking at how these differences across areas change over time, or difference between owners and renters, because we're comparing those two groups in areas with faster and or slower house price growth. In addition, we can do a regression analysis where we control for other differences between the parents of these children, including information we see in the census and the longitudinal study on their occupation, education, and other characteristics. So now I'll show you what this means graphically. So we'll start by looking up a group of people who grew up before the housing boom. So these are people who, on the left-hand side, is a graph showing the housing wealth of children of some people who are aged 28 to 37 in 1991. So they came of age in a period when house prices were not going up rapidly. And the red line shows the housing wealth for children whose parents were renting, and the black line shows the housing wealth for children whose parents were owning. And on the x-axis, we've got areas ranked by how rapidly house prices went up in the boom period in the mid-1990s. So what you can see is that the parents who own, their children have more housing wealth than the children of parents who are renting. But there isn't much of a gap, or there isn't much of a difference in the gap according to how rapidly house prices are rising across those different areas. On the right-hand side, we've got our post-boom cohort. So these are people who are aged 28 to 37 in 2011. So you see the same difference between the black and the red line. So the children of parents who are owning have more housing wealth. But importantly, what you can see is this divergence in that scale of that gap according to how rapidly house prices were going up in the area where their parents, where they grew up and where their parents were living. So if parents are own in an area where house prices are going up particularly rapidly, that seems particularly important for children's later life housing wealth, which is indicative of this parental wealth effect on how well the children are doing themselves in terms of their wealth. So that was for housing wealth, the pound amount of housing wealth. Here we're showing the same analysis, but for the share of those children who were homeowners. So you can see, so in the pre-boom cohort, so this is the children in 1991, they have quite high home ownership rates. Again, you can see this difference between the children of parents who are owning and the children of parents of renting, and not much difference in the gap. In this case, we see for the post-boom cohort, one, you can see home ownership rates are lower, both for whether parents were owning or renting, and that reflects the decline in home ownership rates. But what you can also see is that here there isn't that much of this change in the size of the gap between renting and owning parents, depending on how rapidly prices increased in their areas. And from that, we're concluding that although it affected the amount of wealth that children had, it doesn't affect the home ownership rate. So how do we explain that? And well, I should say all these patterns hold up in a more complete regression analysis. So how do we explain that? Well, sorry. So and to put a number on it, so every £100,000 of housing wealth the parents have causes the child to have an additional £15,000 for that post-boom cohort, age 28 to 37, according to analysis. But there's no effect on home ownership rate, so getting on the housing ladder. And we can account for that by saying that the children of richer parents, they're just as likely to buy as the children of parents with less housing wealth. But when they do buy, they buy more valuable homes. And we can ask what accounts for this. And the key reason is where these people are buying when they're able to buy. So what this graph shows is the effect, using a similar methodology to what we showed before, of an additional £100,000 of parental housing wealth on the likelihood that children end up in different locations. And so what the green bars shows is children initially outside that location. So you can see the first region is East Anglia. So those are children who grew up outside of East Anglia. What's the likelihood that they end up moving to that region if their parents have more wealth? the blue bars are what's the likelihood that they're in that region, so they might not leave that region rather than moving to that region. And the gray bars are whether they own in that region. And what you can see from the bottom is when looking at London and the rest of the southeast, there's this increase in the probability that if you have wealthier parents, that you're going to end up owning in London or the greater southeast, which of course very expensive housing markets. And so that might explain why these children end up with more valuable homes, is because they're in locations with higher house prices. You can see some weaker evidence that people from outside these areas are likely to move to those locations if their parents have more housing wealth. But it's a combination of several forces going on. So it's people being more likely to move there, people being less likely to leave there to an area with lower house prices if they grow up there, and conditional on moving there being more likely to own their home when they move. So what we see is that parental housing wealth helps children gain or maintain access to these very prosperous places in England, so London and the southeast. So another question we can ask is, did this, along with other advantages conferred by having parents with more housing wealth, translate into greater success in the labor market or higher wages for these people? As I said before, here we have to work with what we have in the census. So the census doesn't ask you directly what your income is or what your earnings are in your job, but it does ask a lot of information about your job. So we know how many hours you work, what occupation you're in, what industry you're in, and what region you're in. And from other data, we can work out how well paid those occupations are and in different industries. And that can give us a measure of how much we think these people could be earning on the basis of the jobs that they have. So if you see someone working in finance, you can infer that they've probably got a good salary, for example. So what this graph shows again is the impact of that increase in parents' housing wealth. So these are parents that did better out of the housing boom in the 2000s, and what happens to their children in terms of the occupations, how much earning the occupations they move into are associated with. And we split the sample according to whether the children were men or women when they reached adult. Whether the children were men or women. And what you can see for men is there's this decrease in the likelihood they're in these middle earning occupations, so 40 to 60% of the earnings distribution, and an increase in whether in the top quintile, and a lot of that is whether in the top 10% or top 5% of jobs. So what this tells us is that parental housing wealth increases the ability of these male children to access those really high-paying occupations. What you see from the red bars is we're not seeing the same effects for female children of these parents. So these children, you don't see women from parental backgrounds where they saw a greater increase in housing wealth, seeing particularly better outcomes in terms of earnings in the labor market. So that's a sort of difference between, that's an interesting difference between men and women. That's something we might be able to explore in the future. So to give more detail on what that means, so what this graph shows is a breakdown in the individual occupations that we're seeing people moving into. So on the y-axis, that's the effect of an additional £100,000 of parental housing wealth. So that the occupations at the top of the graph, those are the ones that people with parents who are doing better are more likely to move into. And on the y-axis, you've got the earnings of those occupations. So when you see in that top right-hand quadrant, those are occupations, excuse me, sorry. And when we've highlighted these in red, those are how much these occupations are paying in London, and then gray, that's how much they're paying in occupations outside of London. So what you can see is this increase in the likelihood that they end up in these very high-paying occupations that have a particular premium to being in London. So, for example, business, media, public service professionals, they earn much more if they're in London than they do in non-London. You can see the gray version of the dot lower down and slightly to the left. So they're less likely to move into those occupations outside of London that pay middling amounts and more into these high-paying occupations in London. The other thing you can see is there's a small dot. So all these dots, based on the size of the importance they are in the labor market, there's a small dot there for cultural, media, and sports occupations. So that's an occupation that people are actually more likely to move into with parental wealth, but it's actually paid less, slightly less than average. And so one way of interpreting that is these are jobs sort of in fashion and journalism and things. These might be prestige occupations that don't pay as well, but have other amenities with them. They're fulfilling in ways apart from the earnings people get from them. Okay, so now we can talk a bit about mechanisms. So what we've seen is that parents who did better of the housing boom had these additional resources, and it seems that those resources mean that they could help their children potentially in a number of ways. So one way is they could leave bigger inheritances. So these children are unlikely to have received these inheritances. For most of these children, their parents will still be alive, so they will not have received these inheritances yet. Of course, they know that they're quite likely to get a better inheritance in the future, and that might affect their behavior today. A second thing these parents might do is, because they've had more resources, or they knew they were getting more resources from these house price increases, they might have had more money to invest more in their children's, their education, and so forth, that might improve their outcomes later. And the third thing they could do is, given the additional resources they have, these parents could make financial transfers, or might have greater scope to make financial transfers to these children apart from inheritance, so while both parents and children are alive. So for example, when the children are buying their home, that might be an event where the parents make these financial transfers to children. So what we can ask using data from the Wealth and Assets Survey, which asks about the gifts that parents give to the children, whether we see any evidence of the third of these channels working. So whether direct financial transfers play a role in helping these children buy in these more expensive locations, as we've documented. So here's a very similar graph to what we were looking at before, showing for parents who were living in areas where, excuse me, living in areas where house prices went up faster. If you're a parent owning in that location, you're much more likely to have given a larger amount to your children over the last 2 years than parents who are renting in those locations, which saw this high house price growth, which is again indicative of these this housing wealth, meaning these children have greater scope to give their children, these parents have greater scope to give these children financial transfers, particularly, for example, around the point of where they're putting together a deposit to buy a house. Okay, so and then a final question we can ask is, how does this matter for social mobility in general? Can we say something about how much this housing boom affected social mobility? So to ask that, we can ask, what's the effect in general of a parent climbing up in the distribution of parents' housing wealth by 1 percentage point on the same rank of the child? And the second question we can ask is, so suppose that all parents had seen no real terms housing wealth in the boom years, so there hadn't been this housing boom. Based on our estimates, what would that have done to this relationship between parents' housing wealth and child housing wealth, or that measure of social mobility? So we do that in this graph here. So the red line is what we actually see. So we see for each, if the parent moves up 1 percentage point in the housing wealth distribution, child moved up 0.28 percentage points in the wealth distribution. So there's quite a strong effect of parents' wealth on child's wealth. But if that boom hadn't been there, so that's shown what the gray line, if we imagine a situation where there had been no housing price boom, we would see that relationship halve. So on this measure, the persistence in wealth would have halved, and that would mean higher social mobility on this measure. So I think I'm at time, so I'll finish up and hand over to Jan for his discussion. So what we've seen is that the children of parents who benefit from the property boom are more likely to have greater property wealth themselves, to buy homes in London, and for men to enter the highest earning occupations. And because of the approach we've taken to do this, we're quite confident in being able to attribute this impact to the effect of property wealth itself rather than to other factors. So what this tells us is that property wealth gains among parents do confer advantages on their offspring. And this has an implication for policies that might affect social mobility. So this could be taxation, how we tax gains arising from property wealth, but also could have implications for what we think the effects of housing supply constraints might be. So if we have housing supply constraints in booming areas, that might mean that house prices go up more in those areas, and that might mean more inequality amongst the subsequent generation on the basis of our analysis. So that's all I had to say in my presentation today. So I guess I'll now hand over to Jan.
Yeah, Peter, thanks a lot for the very interesting presentation. So let me just share my slides that I have here and get this little window out of the way. Yeah, I want to talk a little bit about sort of the background that maybe puts this research into context, and also talk about sort of maybe wider implications that you haven't talked about yet. So I think this is very interesting research that actually the implications go beyond of what you already mentioned. So as a background, I think there's sort of two important observations from the related literature that are useful to understand why we might care quite a lot about this research question. And the first is that income and wealth inequality have risen in many countries over recent decades, including in the UK. And the second is this observation that higher inequality seems to be associated with lower social mobility. And so we observe that as sort of statistical associations across countries, across regions, and also over time. And there are also theoretical reasons why we might expect such relationship, that when inequality goes up, that maybe social mobility should be expected to decline. And so I think there's this concern, sort of like this key concern in the literature, whether social mobility maybe is already decreasing or is bound to decline in the future. And so that's kind of the wider background. And then I think there's sort of the specific UK context that makes this work interesting, which is, of course, the rapid growth in house prices, especially in the South and in London. And this observation that this has been a major driver of wealth inequality, which, quite related, is the observation that in general in the UK economic opportunities, Peter, you talked about sort of these different occupations and sort of certain careers being concentrated in London. And so if you think about house prices, that of course goes along with this notion that certain opportunities are actually concentrated in the most expensive regions. And then there's already some previous research showing that intergenerational persistence in home ownership has increased in the UK. Okay, so I think the sort of this general background together with the sort of specific UK context makes the research question quite relevant. Now, just as a sort of very short summary of how I understood the paper. So the paper identifies an important mechanism through which housing wealth affects children's location and career choices, and thus social or intergenerational mobility. And so I think about it it has sort of these two components, right? The first one is pretty straightforward, that rising house prices make home ownership harder for younger generations and increase the intergenerational persistence in housing wealth. That one is sort of simple and more intuitive. And then the second part of the story is a bit more complicated, which is this question of what changes in parental housing wealth due to intergenerational mobility. And so surprisingly, it does not seem to, so gains in parental housing wealth do not seem to increase the likelihood that children own a home in adulthood as such. Instead, it affects where they live and buy, in particular by increasing the probability that they move to the most expensive cities, such as London. And if they buy in London, then of course they will tend to have higher home ownership wealth later in life. This sort of residential choices in turn influence career choices. And for example, have an effect on the probability to become a top earner. There's sort of this one headline finding that I think falls out of all of this, that is that the house price boom seemed to have doubled the persistence of wealth across generations. Okay, so quite a striking finding. If I would pick sort of one figure from the paper that kind of maybe summarizes the evidence in some sense, I think I would show this paper that you show, this figure that you showed, Peter, which is showing this effect of parental housing wealth on living, moving to, and owning a home in London, okay, and the rest of the Southeast. And I think sort of a lot of the other things that you talked about, they really follow from that, right? So it's kind of intuitive that once you live in London, you have access to better type of jobs that has its own effects on its own implications on income. And so a lot of the rest of the story, I think, follows from this figure. Now, I want to talk about sort of two things that came to my head, that sort of popped in my head when I read your paper. And the first was whether the story is really specifically about housing wealth, or are at least some parts of the story about wealth more broadly. So wealth inequality has increased across different asset classes, and housing is just an important one, but it's just one of them. And so the question arises if other forms of parental wealth would have a similar effect on these location choices, career choices, and the implications of these choices for income. So what is it sort of that makes housing different from other forms of wealth? Sort of the best answer that I could come up with so far is that maybe the key difference is that change in house prices operates through these two channels, and maybe these channels are reinforcing. So they raise the cost of purchasing a home for everyone, but they increase the wealth only for families who already own property. And so I guess other wealth shocks, they share the second mechanism that if you have an increase in certain forms of wealth, that some families will benefit more from that than others. But I guess in combination with this first mechanism, that at the same time, the cost of purchasing a first home goes up for everyone, I guess that makes maybe the sort of the housing wealth channel particularly forceful. And I think it would be interesting to discuss this more in the paper. The second thing I want to discuss is whether these mechanisms that you highlighted, whether they actually might have wider consequences than the ones that you already mentioned. The first thing is the question of whether rising house prices may increase segregation and generally widen regional inequalities. So we know that where children grow up matters. We know that this shapes educational opportunities. It shapes long-term prospects. There's sort of a large literature showing that these things matter. And my sense was that sort of this story was still a bit missing in your paper, in the sense that you focused very much on what happens in the labor market. So people move to London, they profit from access to better careers, they might have higher incomes, they might profit from higher home ownership values. But of course, these moves, they also have implications for the next generation. So for their children, where they grow up and what type of schools they go to, who their friends are. And my sense is that this might have sort of like another level of implications for inequality and social mobility that goes beyond of what you've already been discussing. Related is the question of whether there might be some feedback effects of productivity. So inequality segregation may reinforce each other because there might be productivity spillovers from certain individuals moving to certain places. And so the story that I have in mind here is that, of course, one thing that makes London more productive than other parts of the UK is the inflow of highly educated young workers, which in your story, it's about workers from high-income families or from families who have high wealth. But of course, those children also tend to have higher education. And so this moving to London, it profits those individuals in terms of access to careers, but it might also have implications for why London offers better careers, offers higher earnings, and has higher property prices. So these sort of feedback effects might be another interesting aspect to your research. Okay, so I want to conclude. I think my takeaway from this is that the mechanisms that you highlighted, they're very interesting. They have broad implications for inequality and social mobility. And I actually think if you sort of spin the story further, they extend beyond the mechanisms that you already highlighted, and it also extends beyond wealth persistence as such. Thank you very much.
Brilliant. Thank you very much, Jan and Peter. And let me take the opportunity to say a big thank you to Homes England, who funded this work. So very much thank you to them. There are already some questions on Slido. Keep them coming in, keep voting for them. Before I get to any of those, though, Peter, I'm going to give you the opportunity to respond to some of the things that Jan just raised. So let's pick up on the point about, is housing wealth different? So if other wealth shocks came along, would we expect similar outcomes, do you think?
Well, so as Jan mentioned, one of the reasons that housing wealth is different is you can't, I mean, an increase in house prices, that's a positive shock for some people and a negative shock for other people because they can no longer afford to buy. So that is one aspect of it. I guess there's two other features that mean that housing wealth is different. The first is that it's illiquid. It's quite difficult to access compared to financial assets. So one question is, even if parents see these big increases in the values of their homes, is that actually something they're going to be able to access and give to their children? And what we see in these financial transfers, from this financial transfers exercises, that does seem to be the case. So it seems that either by directly accessing that wealth or by accessing other forms of wealth, knowing that you have that buffer of housing wealth, these parents have more liquid resources to help out their children in life. And the second reason that housing wealth is, or a third reason, I guess, of housing wealth being different is the way it's treated for tax purposes. So in the tax system, wealth is treated in different ways. And so, for example, in the UK, on your primary residence, capital gains tax isn't levied on that kind of wealth, whereas if you had stocks and shares, you would be paying capital gains tax. So there's a kind of policy, the difference in the way policy treats these forms of wealth that's also relevant.
Great. So yeah, the other thing that Jan mentioned was the kind of mechanisms might have wider consequences. Jan talked about segregation. The top question here on Slido is, in what ways is property wealth basically a stand-in for social class and the accrual of social and cultural capital? So I think this is partly about to what extent is it kind of just the money, like you have some cash, you can pass on some cash, and what is it about something broader that's happening, which I think speaks to the mechanisms that Jan was talking about. Do you want to touch on that, Peter?
Yes, I mean, I guess yes, this location, getting on the housing ladder. Why is this why is this any different from any other kind of form of way parents might give advantage to their children? And I think it's this key thing is this access to these labor markets. So there's this potential that it is cheaper in terms of running costs to own than to rent. And so if you're able to access these really expensive labor markets, you're able to access these high productivity jobs, and you're able to move up the job ladder in ways that other people cannot. And so that's a sort of form of inequality that arises as a result of these wealth differences.
Brilliant, thank you. Let's do a couple of quick-fire factual questions that people are asking. I'll put two together. One is, are you going to update the results with the 2021 census? Because the person asking the question is worried that basing policy on old data is problematic. So maybe you can pick on, is it still useful for current policy? And wrapped in with that, how do you measure housing wealth? So how do you measure it? Yeah. And are these results still relevant for policy?
So we would really like to update the analysis with the 2021 census. It's just, so it takes time after the census is completed to be processed, and then also to be linked to the other censuses. That has taken some time. So we should have access to that now, and so we should be able to look into that. And that would also be useful to see, some of these later life differences. So, from 28 to 37, some of these differences between these kids might not have emerged, but it might matter much more in terms of your career progression, which occupations you get into kind of later in life. The second question, yes, a nice technical question. How do we measure property wealth? So while the census doesn't ask, what you think the value of your home is, We do know the location where these people live. We know the type of home it is, if it's detached, terraced, whatever, and other aspects of it. I think the number of, no, excuse me, house type and location are the main things we know about the property. Of course, we know if they own or they rent the property. And from that, we can look at the value of homes of that type sold in different areas, and we can fill in from that the value of these properties. So it's imperfect, but it's a pretty good indication of the level of wealth both the parents and the children are likely to have.
Great. So there's a question here that I'll ask both of you. Maybe I'll come to you first, Jan, which is basically about, I think it's related to this question about, are these results still relevant for kind of what's happening today? So London may have reached an affordability peak, question whether that's true, but which may affect its competitiveness and advantage for the regional cities with lower property prices. How should this perspective impact policy making? So if London had reached affordability peak, what would that mean, Jan?
Yeah, I think there's this general, of course, notion that the housing market sort of provides a barrier to particular places, particular cities, outcompeting other places more and more, right? So London is already very expensive. So this puts some limitations sort of to how many people can move to London, who can afford to move to London. But I think there's sort of two different mechanisms that matter here. Like one is, yeah, so if London becomes less affordable, fewer people can move into London, and that might decrease the productivity of London, and that might be a chance for other cities. But the other thing is that's going to happen is that it changes the composition of who moves to London, right? So if London becomes less and less affordable, then it's only those with the highest wealth, those with access to the best careers who can move to London. And the implications of that are a bit more complicated because if you think there might be some sort of spillovers from being in a place with many other very highly educated people who are working very interesting jobs, then this, of course, might actually increase the competitiveness of London further by sort of changing the composition of who can still afford to live in London. What's sort of the overall effect of that? I don't know.
To comment at this point, Peter, about, I guess it's partly a question about things might be different in future. So in some sense, the shocks have already happened. I mean, they're still working their way through the system, but we're not seeing the same shocks today. And actually, we might be seeing different things happening today because London might be coming, so how can we speculate about the future for all these things?
Yes, no, I mean, the questioner is exactly right. So that the house price boom, house prices aren't going up nearly as fast as they were in the 2000s. There's a sort of question of, if prices are stagnant, does that mean it's more affordable for people? It kind of depends on why they're stagnant. So, higher interest rates or difficulty in accessing mortgage credit, that could make London less accessible. So in terms of the sort of generation that's coming through and buying now, it's kind of, stagnant house prices. It really depends on the reason what that is, whether it's more affordable or less affordable for these people and for whom. And I guess sort of the implication is, if in booming periods that has implications for the next generation in terms of inequalities for the next generation, in periods of house price stagnation, that also might mean more social mobility than we otherwise would have. I think that's safe to say. That's the sort of implication of what we're finding.
Great.
Or arguing.
One question here, which I think is one of the most surprising results, and that you highlighted as well. So the question is, why do you think men and women's earnings are impacted so differently by parental wealth? So you set out some of the possibilities there, Peter. I mean, to what extent do you think it's just a preferences story that you either put more money into children or you give them opportunities to be in London, and men are more likely to pick jobs in stereotypical finance, women pick it in media? I mean, do we know how much of it is preferences versus differences in investment or differences in choice sets or something?
I mean, this is a great question, and I think it's definitely worth exploring to sort of understand the reasons why. I can't give a firm answer. I mean, one can tell stories, like you said. So maybe it's kind of, so if you've got these better opportunities, maybe women are more likely to go into these jobs that are kind of they have these non-wage benefits. They're fulfilling in various ways because sort of like we like doing economics research, and that makes our job more interesting. So that's one of the reasons we pick it. So it could be a story of preferences, like you said. There could be other things going on at the same time. I don't know. I mean, this may be unfair to put Jan on the spot, but if there's findings in the rest of the literature that sort of suggests that this pass-through, wealth persistence or other forms of persistence differ across the sexes, I don't know if that's something that's been found in the wider literature.
Yeah, I think one dimension you already mentioned, that sort of men and women choose jobs differently, with women who seem to put more value on non-wage benefits or advantages of certain type of jobs. And yeah, as you said, one could sort of push the story through to say, okay, if you're less interested in some of these sort of very high earning careers and you're interested in other sort of job attributes, then maybe this affects your location choices, and maybe that affects why we see these gender differences. But I'm also speculating here, exactly like you, and I think the conclusion from this question is that you will need to write another paper on specifically this question.
But it's important, I think, to highlight one thing there is that, so we don't know is the answer to the question, but on lots of those stories, it is something about preferences. So I think you can't interpret them as saying that men are getting benefits and women are not getting benefits. Actually, the women of parents who have high wealth and wealth are getting benefits potentially, just not in the form of high earnings. They could be getting benefits in terms of more enjoyable, more flexible jobs they like in other ways. So it's not necessarily that men are getting things that women aren't getting, they're getting different things potentially. A factual question, I think I know the answer to this, but I'll ask you the question. Did you analyse differences between kids of different types of renters, so social versus private sector tenants, where the questioner is thinking that maybe the latter, the private sector tenants are maybe more vulnerable to price increases, and that could impact non-housing wealth. So different types of renters.
We haven't done that particular to split. I need to think about whether that's a point we need to think about. Yeah. So whether the price rises would affect those groups differently.
Great. Another couple of quick factual questions. The references to wealth transfers across generations, but how they are being achieved without inheritances. It seems to me that sources of funds only applies to older people and not the cohort in this study. I suspect the answer just is financial transfers in life.
Yes. I mean, so parents sometimes help their kids out, the bank of mom and dad when you're buying a house. So that could be direct help with a deposit. Maybe they basically transfer the money to you for the deposit, or give you a loan, or yes. I mean, those would be the kind of financial transfers in life. Of course, it doesn't have to be that. It can be the surety of knowing that your parents have those resources. That means you can take more risks yourself. But that is one channel we think is operating, is this direct.
And that one's important, right? So it could be actually that there is no financial transfer, but I take on a bigger mortgage knowing that if something went wrong, there's some fallback option, or I took a risk and moved to London because you have some kind of parental insurance. So it isn't necessarily upfront financial transactions. So another question, so I'm going to ask you the factual question. I'm going to ask Jan whether you're surprised about this. So Peter, why don't wealthier parents contribute to an increase in home ownership rate? So you said that conditional on getting on the housing ladder, you get a more expensive home, but it doesn't affect who gets on the housing ladder in the first place. Why do you think that's happening?
So we think it's because of where people are moving. So it's that if your parents have more resources, that you move to a more expensive property market where it's more difficult to buy a house. But when you do buy a house, it'll be worth much more. So that's what we think is going on. It's the cost of moving to these markets that means it's actually you're moving to somewhere where it's more difficult to become an owner. But once you have become an owner, your house will be worth more.
Are you surprised by that, Jan? Are you surprised that it's coming so strongly, not through you get on the housing market in the first place, but actually it's really just about if you get on the housing market, you have a high value home because of this effect Peter's talking about basically London and South East dominating.
Yeah, I think this was one of the most surprising findings in the paper. I would have expected an increase. I think the explanation that Peter gave is plausible, right? There are two countervailing forces. One is that, if you have higher wealth that you maybe got from your parents, in general, that makes you more likely to buy a house. But if it also changes your location and now you move to London, where generally it's harder to buy a house, then these two effects might cancel each other out.
Right. So Peter, panning out, so this is a question saying, in what ways, if any, do the findings of this study support or challenge the Deaton review of inequalities? So I should say for listeners that IFS has been undertaking this huge review of inequalities. It's happened over the last 5 years. We've been mapping inequalities and all sorts of things, not just income and wealth, but everything else you can think about, and thinking about the policy implications of that. Maybe we can share this question, Peter. But Peter, do you want to start with how does that fit into that broader look at inequalities?
I need to cast the Deaton review feels like ancient history now, so I can't always remember exactly what was said in that particular review. I think so. What's new here is the kind of errands for the UK on this causal effect of housing wealth. So I think so in the Deaton review, we certainly, and in other work, we certainly documented that these patterns, okay, there is persistence in wealth and income, that the children of higher income parents or the children of wealthier parents tend to be wealthier and higher income themselves. But what we're really trying to get at here is this causal role, well, identifying that, what we can more confidently say is this is the effect of parents' wealth, rather than a wealthier parent being, transmitting other things to their kids. So sort of, helping them at school or investing in their or them being in a better neighborhood, or all these other things that might affect how well a child does in life. It's identifying this role of wealth specifically.
Yeah. So I've been working on recently pulling out the policy conclusions from the Deaton review. And I think actually I'd say this study very much fits in with the spirit of that. I think there's two things that stood out to me that makes it consistent with the broader review. One is that just there are many different forms of inequality. It's not just straight about income or wealth. It can be things like inequality in the safety net that your parents provide you, for example. So actually inequality is this very multifaceted thing, and that there can be real persistence across generations. And this is one of the channels through which it can happen. The other thing that I think the review highlights, and I'm going to come on to this to ask your question, is that we shouldn't always think of just sort of seeing outcomes, then trying to use tax and transfer to try to change the effects. Actually working out the mechanisms as to why inequality is happening is a good place to start, because sometimes you want to think about fixing kind of why the inequality happened in the first place, rather than just saying it happened, now let's look at it. So that brings me on to the question I was going to ask is, what can governments do about all of this? So we've identified a source of inequality. It's one that I think feels unfair to many people, because like you described it, Peter, it's a lottery. It wasn't that some people worked harder and had higher wealth and some people didn't. It was just that kind of your parents were in a place in a time where they happened to get this kind of house price lottery win, and therefore that affected you. So yeah, so what do policymakers do? I guess two questions really. What could they have done back at the time? Because and then given where we are now, what could we do to get ready for these things for the future? Peter.
So one aspect is something we've already touched on is the way these things are treated by the tax system, and you're right. So when someone's house goes up in value and they didn't anticipate that, they just happened to have bought the home at the right price and the right time. That's an economic rent. That's something they're getting, not because they had a good idea or because they worked hard or any of those things. It's a reward for something that is down to a large extent down to the luck and fortune. And the fact that the tax system actually treats those gains kind of quite leniently compared to other forms of investments or in terms of income, other forms of income, that I think that's something the IFS has pointed out before, and as something kind of anomalous, and correcting that thing might have what these findings suggest is that correcting those differences in the way we treat these gains versus other forms of income or wealth gains would have implications for social mobility. There's also potential for housing supply. Obviously, there's lots of trade-offs in how many homes you build in an area and why you don't want to build in some areas and don't want to build in others. But when an area does see booming house prices, in other work, what we've shown is that a boom in house prices does not really lead to that much additional construction in areas, even though it's more, you should be able to get more from selling a home in those places. There isn't a big increase in supply in response to these big increases in prices. And so relaxing some of these constraints on building and preventing these particular booms occurring in these particular places, that would also have implications for social mobility. Although we do know that in those areas that policymakers face a lot of trade-offs, and there's a lot more going on just beyond what's happening to house prices and what's happening to wealth.
Yeah, and do you want to say anything about potential policy responses to these kinds of issues?
Yeah, I think Peter put his finger on very specific policy recommendations. I just want to make a more general point, which is that, yeah, if we think about policy, one key issue here is that wealth as one form of advantage buys you another form of advantage, which is sort of access to better paying jobs, to better careers. And I think if we talk about policy, that's a crucial issue, right? That access to these better jobs is in specific parts of the countries that are just less affordable to some people. And I think that relates to what you said earlier, Helen, is that this idea of advantages being multidimensional, right? So we're talking about wealth, but one of the key issues here is that wealth, apparently via the housing market, buys you other forms of advantages. And why we might have different feelings about sort of to what extent this sort of wealth inequality and inheritance of wealth is warranted. Probably people have very clear feeling about this idea that certain type of careers are just not accessible. That this is clearly a policy issue that would need to be addressed.
I mean, on the tax point, I think it's also, I mean, you're right, Peter, we've written about this lots before. I think one particularly tricky thing about the kind of taxing capital gains on main homes, if we could do it, I think there'd be lots of benefits to doing that. There's a kind of political economy issue that if you had a government that said, we're going to tax the capital gains on main homes, the opposition party could very quickly say, well, when we come to power, we're going to get rid of that, and you'd completely go up the housing market. So it's one of those unusual cases where it would be great if you could tax those rents, those things that weren't earned, they were just luck. But for political economy reasons, we have a particularly difficult time actually putting a tax on them. Not so we shouldn't try doing something there, but I think that's an unusual case. Also, perhaps worth highlighting, relating to the Deaton review, that there's an increasing body of work on kind of place-based policies and thinking about the UK is actually pretty unusual compared to European countries in being very dominated by our big city. We don't have kind of strong second, third, fourth cities in the way that other European countries do. And there's a question there about the extent to which policymakers could or should try to change the equilibrium so that we had less pressure on London, whether that would affect some of these things. We're almost at time, so maybe one more question. Sort of stepping back from all of the analysis, this question here about what caused the house price boom in the first place, and perhaps we can come back then and think about what we could have done to stop that in the first place.
Well, yes, it's a great question. I mean, it was in that period, there was a period of high productivity growth, the sort of dot-com boom and all the rest of it. But there were also at least initially, there was a decline in interest rates, a secular decline in interest rates, and increase in the availability of mortgage credit ability for people to service large mortgages. And I think that's probably the cause of the big boom in house prices. Of course, it wasn't unique to the UK. It happened across Europe and in the United States as well. So there's sort of a global decline in interest rates leading to an increase in property wealth, I think would be my explanation.
And actually, I'll come to you, Jan, but you talked about relation to other wealth. I mean, in general, we know that changes in interest rates affect asset prices. There are other things that are going to go on that affect wealth that aren't just related directly to kind of the earnings somebody has. So those other policies like interest rates that affect wealth or asset values are going to have some of these broader effects sometimes.
Yep. This question was for me. Sorry.
I was saying you're commenting on like how the link between housing wealth and broader wealth, saying actually the point that Peter made about kind of other policies like interest rates affecting wealth, that will be true more broadly into other kinds of inequality.
Yeah, I mean, you asked about the source of the housing boom. I think the UK is just victim of its own success, right? In the sense that London had this incredible pull. I've experiencing that. I've been studying in London, and so I've been on the receiving end, both of sort of the reasons for why people go to London, and then of this incredibly difficult and expensive housing market. And so, housing booms are nothing sort of special. What is, as you said, special in the UK is that economic activity is so concentrated in London. And I like this idea of, of course, policymakers should think about how to strengthen the second, the third tier cities so that this concentration is maybe a bit reduced. Although you want to be careful with that, right? Because maybe this concentration is maybe sort of the reason why the UK has been doing well in many ways. That certain occupations, certain firms, maybe they really need to be in London to reach this high productivity, to be in this high sort of international labor market, in this large international labor market. And so it's easy to say, yeah, we should have more economic activity in some of these other cities. But I guess the question is, what forms of activities would work well in those other in those other cities?
Absolutely. It's much easier to identify a problem than to find a solution. But on that, we're at time, so we should wrap up. Let me say thank you to Peter, thank you to Jan, thank you to all of you for listening. The Blocksmore IFS event's coming up, so do tune into the next one. But for now, thank you.